Hi, how are you doing? My name is Joseph Heintzelman, and I'm happy to be here with you today. I was invited here to speak with the Rotary Club, and I'm also a Rotarian. I belong to the Lake County Golden Triangle Club. That's based in Mount Dora, Eustis, and Tavares. And so, very happy to be here. Very happy to speak with you, fellow Rotarians. Um, and what I'm going to be talking about today is about what I do for a living. I'm a financial advisor with Edward Jones, and so we're going to be kind of going over some certain rules of the road, as you might want to say, some things to think about as you're going down your life path and what you can do to achieve your goals financially, and some things to keep in mind and some things to be aware of. And I find that many of my clients find these things very helpful. And it's always a good reminder to kind of hear these things again, because sometimes we just forget. So that's what we're going to do today is share those rules of the road, and hopefully you learn something and are entertained a little bit. So to get started, we're going to start with rule number one, and that's develop your strategy. Now, a lot of us can spend a great deal of time planning a vacation, especially one that we're looking forward to, and especially one that a place you've never been before. Many of us will take many hours to research things, find out when we're leaving, how we're getting there, what we have to pack, what's included, what's not included, so that we make sure that our vacation is as good as we want it to be, make it a memorable experience. Unfortunately, a lot of people don't do that the same way with their finances. Finances seem to be kind of on the back burner when I get to it, when I have a chance. And then sometimes we end up years down the road and not really sure how we got there. So, taking time to develop a strategy is very important. And your strategy needs to be based on a few things. Uh, Essentially, your strategy needs to be based on you, your goals, your personal goals, and what you're trying to achieve. At the end of the day, this is your money, this is your life. You work hard for it, so you need to be in charge of what this is working for. Um, Besides your personal goals, you also want to understand how much time you have to invest in the investing world. That's called a time horizon. So does that look like for you 2 or 3 years, or is it a 20-30 year end game? And so that time horizon will help make some decisions about your investments and what you should be doing and how you should be developing your strategy. The other thing you want to consider is your comfort with risk. There's always risks and rewards, but you need to know what your level of comfort is, what your tolerance is for that. Whether you're a very conservative person or a very aggressive person, those can play be very big variables in your financial plan. And then we just need to figure out what are the steps that we need to get to where you want to be. And this plan, this strategy needs to be written down. It needs to be something that you have, or at least have access to, not just I have it in my brain and I think it's in there somewhere. Having it written down, having someone to go over with you is very important to kind of help you keep on track. Obviously, you want your plan to be somewhat flexible, because as you go through your life's stages, you will have changes. There's a plan looks much different for a young family and a growing family and people without a family getting ready for retirement. All of those will look very different, but they'll be based on what you need. So it needs to be flexible, because obviously there will be trade-offs. For every choice that we have, there are trade-offs. But if you have a disciplined approach and a patient approach, your plan will always work out in the end. So that's rule number one, is developing a strategy. Rule number two is to understand your risk. We've talked a little bit about this, but we need to kind of take a little deeper dive into this. So we've all heard the phrase risk versus reward. We generally understand that the bigger the risk, the bigger the reward. Otherwise, there'd be no reason to do that. There'd be no reason to take more risk if you weren't going to get something more for it. So when we expose ourselves and expose our money to greater risk, we want a greater reward. And that's kind of what the stock market is based on. Each of us need to understand our own personal level of this, though. I like to use the analogy of a roller coaster. Um, some people just like that nice, smooth ride, no, upside down, loop de loops, anything like that. They just like it nice and calm. That was great. Some people, the thrill seekers, they love the biggest drops, the fastest roller coaster, the biggest loop de loops there are. That's what they love. And so sometimes we fall in between there. But we need to understand that about ourselves, and especially about our plan and how that works into our plan. And it's important too to understand that in this analogy, the roller coaster is like the stock market. It's going up and down. We'll have times where it's smoother and times where it's rougher. But in the end, if you stay on that roller coaster, you're going to be okay. The only people that get hurt on a roller coaster are the people that jump off. If you just grab on and hold on tight, most of the time you'll make it through just fine. But if you jump off, that's when you get hurt. Same kind of idea with the stock market, with your investments. If you're jumping in and out, trying to time the market, trying to feel what's going on and follow the crowd or follow the news, that you can get yourself in a lot of hot water that way. The better plan is, depending on your time horizon, is to stick with it and see how that plan plays out over a long haul. The hardest part about risk is that it's very emotional. Your money, there's a lot of emotion tied to your money and to when it's going up and down. Obviously, we usually feel happy when it's going up. We feel a little nervous, a little anxious when it's going down. And so this risk that we're talking about and understanding that is really how your emotions play into your plan and how they play into your investing. And so we need to understand that emotional piece is very critical. And that's why having someone else to help you get through that is really important. There are three basic type of risk. We're not going to go very deep into them, but just there's three basic types that when we talk about the stock market, we need to understand. The first one's economic. That means that just like anything, the economy cycles. There we have good economies, bad economies, recessions, growth. We have all sorts of things like that. And so the economy itself will introduce some ups and downs and some risk into the plan. The second one is inflation. Historically, inflation has grown at 3%. And inflation basically just means that your money is not worth as much in the future. You lose buying power in the future. $100 today is not worth $100 10 years from now. You need more money to buy the same amount. And so over the years, historically, 3% has been the inflation rate. Currently, right now, it's only at 2.2, so we're kind of on the lower end of the spectrum. But that's an important piece to remember, because if we don't do anything, or if our investments aren't growing at least with inflation, then we're eroding our purchasing power. And the last one is an interest rate risk. The Federal Reserve Bank sets the interest rate, and so that can play with how our savings and how our investments are also affected. Primarily based on, a lot of banks and mortgages use that federal interest rate to base a lot of their rates off of, same as credit cards. And so that can play a part into our overall financial plan. So that's risk. The third rule is making sure that we have a diversified foundation, meaning that we don't want to put all of our eggs, all of our stuff into one basket and hope for the best. Because if we have a problem, if we have a trip, a fall, a stumble, then all of our eggs can be broken or scrambled. And we don't want that. And in the world, in our investment world, a trip, a stumble, a fall could be bankruptcy of major companies. For example, we have Sears. That's, 20 years ago, no one would have thought Sears would have been in the trouble they are now. Other ones are natural disaster. We just had a major utility company in California declare bankruptcy because of the wildfires there. And then sometimes it's just due to regulations. that some companies can get in trouble as well. And so what we need to do is diversify. That means spreading our eggs out into multiple baskets rather than being just one. And diversification, then another name for another term for it is called asset allocation. Basically, how you're allocating your different assets. And we want to put them in a different mix. We want to put them into stocks, mutual funds, bonds, CDs, and cash, or some kind of combination of those. But those are kind of the basic ones. But also, we have domestic or US based and international of all of those types. And so, not only do you want to have a mix between the stocks, mutual funds, bonds, CDs, and cash, but we can also diversify between US based and international. Because it's very interesting how sometimes the US economy is doing well, but maybe international is not. And maybe on the same thing on vice versa. If our economy doesn't do well, maybe international economies are. And so that's a good way to spread our risk out as well. One of the ways that we talk about asset allocation is using a ratio. You might hear like a 50-50 portfolio. And all that means is that you have 50% in stocks, mutual funds in the market. And then you have the other 50% that's out of the market in things such as bonds and CDs and cash. Obviously, that ratio can change. So you can have an 80-20 mix, 80 in the market, 20 out of the market. But that ratio also changes during your life. Usually, when you're younger, you're at a higher, more risky allocation, meaning an 80-20, because you want your money to grow. As you get closer to retirement, as you're getting closer to needing to preserve that money or to draw income from that money, you may start dropping your ratio down to a 60-40 or 50-50, 40-60, whatever it might be. But we want that diversification, but we also know that diversification can change through your time, your lifespan. The interesting thing is that diversification is such a big deal because it helps save us from losses. It doesn't protect us from losses. What it really does is it smooths them out. So if we had everything in one basket, for example, if we picked Sears, if we had all our money in Sears stock, when Sears now is going through bankruptcy and becoming worthless, that's all your money. All of it's becoming worthless. But when we spread it out with multiple companies or with mutual funds and bonds, if one thing goes bad, the other things hopefully either go in the opposite direction, inverse of that, and help to level it out to a point. So that's really the point of diversification. It doesn't protect you from loss. People were very well diversified in 2008 and still lost money, which is true. But it did help smooth their ride if they were diversified over many different things rather than just one thing. So it won't protect you from everything, but it does help it not be so rough. The other part is to understand that when we have stocks and bonds, they typically act in inverse relationship, meaning that as one rises, the other one declines, and the opposite is true. So as stocks decline, bond prices typically rise, and the opposite is true. Like I said before, that can happen the same way with domestic and international. And so that's why having all of those things in your portfolio helps your portfolio be able to manage and weather many, many different things. Depending on which one is up or which one is down, you're actually going to come out better in the long run. So that was rule number 3, was diversification. Rule number 4 is sticking with quality. So picking and maintaining quality investments is a very important piece of your portfolio. It's not the most important factor, but it is one of them. That hot stock tip that you get from your friend or the coworker or the newspaper can be very dangerous. Can be very, very dangerous. And so we're not looking for the flavor of the week. We're looking for good quality investments that's going to last over time. Usually if something sounds too good to be true. It really is. There is no free lunch, and people that are maybe trying to sell certain things, they may have an agenda behind it, and so you know, and in the market, it's really interesting that once the news and everyone else has figured out it's a good buy, by the time you get on board, it's probably past the time that it's a good buy, and so so instead of trying to figure out what's really hot at the moment, it's better to look at over a long period of time how a stock or how a bond has responded. For example, any stock or mutual fund can have a banner year. There are companies out there that will just have great years. All of a sudden, one year they'll just explode. But then if you go back and look at them and look at their track record for 20, 30 years, it's not so good. It's kind of low, below average. But that one year really stood out. And so that's what we're looking for. We're not looking for the 1 year that they stood out. We want investments that will stand the test of time and provide nice, level, smooth returns year after year after year, even if they're not quite as big as some of these other ones. The other thing too is with bonds, they have what they call credit ratings, and that's how you can kind of tell what types of bonds you're getting into and what quality they are. For example, there's two main categories. You have investment grade, and then you have high yield, or another term is junk bonds. Most people have heard the word junk bonds. So you have investment grade, which typically means that the company that you've borrowed the money from has a track record of being able to make all their payments and not missing one. They also have financial security, meaning that their balance sheets and their financial statements show that they are stable. When you get to the high yield junk bonds, those are companies that don't have those yet. Sometimes it can be a startup company that they just don't have enough track record to show that. But a lot of times it's other companies that lack one of those things, and they have to produce higher returns to attract people to them. And so that can be sometimes a dangerous thing. So that's what it means when we say sticking with quality. We want things that are tried and tested, that will last for a long time, and not just the flavor of the month. The next one, rule number 5, is having realistic expectations. Now this is really, really important, because a lot of people think that, I'm going to get rich quick. I'm going to make a whole lot of money real fast. And sometimes that's not the case. Most times that's not the case. If someone comes to me and says, hey, I have $10,000 making $1 million and I want it back in 3 years, there's not anything legal that I know that you can do that makes that kind of money. So we have to understand where we are and where we're trying to get and how realistic that is. The stock market here historically over a period of 15, 20 years long term has always returned positive returns, meaning that if you left it in there for long enough, then you would always make some money. However, you can be very volatile inside of that. Any one given year, you could jump as high as 35% or lose as much as 20%, and sometimes more. And so there will be a lot of volatility and up and down each and every year, but we're also looking at the long-term trajectory of how it's growing. The other thing too is to consider that each type of asset typically has their range of return. Stocks, for example, typically average, depending on how aggressive or conservative you want to be, would be anywhere from 6 to 10%. You can get a little lower, you can get a little higher, but kind of on average, 6 to 10, 8% is kind of an average. Stock or bonds, on the other hand, they're much more conservative, and so they're pretty much like a 2 to 3% range. And so depending on what you're trying to do and what type of investments you have to realize what types of returns that they will give you. So if you're wanting big 8-10% returns, buying a bond doesn't make sense, because it's not going to give you that. On the opposite side too is if you want those big returns of a stock market, then you are going to have to put that at risk to put it in the stock market. And the research has shown that it's better not to try to time the stock market, trying to jump in and out, day trading as they call it. Research has shown that very, very few people actually do that very well and successfully and make money at it. And so it's really better to have that realistic expectation that if your money's going to grow over a long period of time, that's really what you want. That's what you're looking for. If you want shorter term investments, there are vehicles to do that, but they typically don't have as good as return as well. And the last rule is to prepare for the unexpected. So most people, a lot of people, spend a lot of time working, and we all go to work. We work hard, so we're out there busy making money, and we're trying to build wealth and secure ourselves and our families financially. A lot of times, though, we forget to protect that, because at any point in time, some unforeseen event can occur that can severely alter a plan. For example, an untimely death, untimely disability, untimely illness, and we're talking like a major illness, a cancer or major surgery of some sort. Any of those things can really derail a financial plan. And so not only do we need to worry about making money and building wealth, but we also need to protect it to make sure that it's there when we need it. So there's three basic ways that we can help prepare for the unexpected. And the first way is to create an emergency fund, meaning that we want to set aside some cash or cash equivalents, kind of like either money markets or something like that, that give us a little bit of interest, but is accessible and liquid. We want to be able to get to it if we need it. It's kind of a grandmother's rainy day fund, right? So if your transmission blows up or the water heater in your house goes out, you're not having to put that on a credit card and hope that you can make the payment. Having that little bit of cash will help you with that. The rule of thumb for a emergency fund is you want 3 to 6 months of expenses. So if you're starting out maybe on the lower end of a 3 month, as you get more established, maybe a 6 month, that way you can weather not only like death and disability, but even maybe like a job loss. That can be a huge crisis in most people's lives, is a job loss. So having that extra money is a really good buffer. The second one is you want to be properly insured. So this means everything from auto insurance and home insurance to make sure that your stuff is protected. But besides that, you also need health insurance to protect against major medical issues, and life insurance. And part of life insurance, but it's kind of separate, is long-term care insurance. So all of those things help protect your assets, and especially with life insurance and long-term care insurance, that can help alleviate the need for you to spend all your money and possibly run out of money in retirement, or protect it so that you can leave it for someone in the future, meaning leave a legacy for someone that you care about. And the third one is to plan your estate. Most people don't like talking about when they're going to die, but it is inevitable. All of us do it, and so we want to make sure that our wishes, what we want done with our stuff and with what we want done with our estate, what we want done with our legacy, is documented properly. Typically, you want to go through some type of estate attorney to make sure that your will or trust or estate plan is properly documented, and then let people know where that is. So in case something did happen, that they would be able to retrieve that and be able to follow that to the best of their ability. So those are some of the things that we do to kind of protect ourselves. Have some cash on hand for emergencies, make sure we're properly insured, and then look into the future in our estate. So those are the 6 basic rules, and that's what I do every day. Is I help people understand these things, teach them and educate them about all the different pieces, all the different investments, all the different strategies so that they can make wise decisions for their own personal lives and their own personal goals. And so I'd be happy to help anyone that would want some. I know that the contact information is available. And if you ever need anything, need to ask a question, always feel free to reach out to me. It does not cost you anything to ask questions or just sit down and chat with me. And I appreciate this time to come and talk to you, and look forward to seeing you in the future. Thank you.